Hello guys, welcome to another video. So today we are gonna to talk about cash budget. In this video we are gonna to cover the definition of cash budget, and then we will discuss why to prepare the cash budget, and we will also talk about the format of the cash budget for essay style questions, and we will also gonna to discuss adjustments related to the cash budget. Let's start with the definition. Okay, so actually the cash budget is an estimation of cash flows for a business over a specified period of time. So you can say a cash budget is a document produced to help the business managers to manage their cash flows. Okay, you can say a cash budget is prepared in advance and shows all the planned monthly cash incomings, I mean to say receipts, and any planned cash outgoings, I mean to say payments. So like here, it means we are gonna to uh, forecast, or we are gonna to prepare cash budget by including two items. First, we will include projected cash receipts, and then we will also include the projected cash disbursements. Disbursements, you can say it's a payments are outflows, and receipts, you can say these are inflows. And cash budget, usually we prepared for a specific period of time. You can also prepare for each quarter. Maybe you can prepare the cash budget for each month. Okay, so this is what is the cash budget. So in other words, cash budget always produce a comprehensive picture of the company, about the sources of cash and about the uses of cash. Sources mean to say like from where you are gonna to collect the cash. Maybe you will collect the cash through the sales of the goods, or maybe you will collect the cash through the loan, or maybe you will collect the cash through the investments. So, and we will also talk about the uses of the cash, like where you are gonna to use it. Maybe you are gonna to use the cash to pay for the business operating expenditure. Maybe you are gonna to pay the cash to the shareholders in shape of dividend. Maybe you are gonna to pay the cash, okay, maybe to the investors, okay, maybe the lenders, etc. So here it means cash budget produce the comprehensive picture of sources and uses. And now we need to understand in the cash budget which a budget we will combine. In cash budget, you will combine two types of budget. Like we will get the information from the operating budget, and we will also get the information from the capital budget. So if you remember, capital budget actually is the budget which we prepare to include the information regarding the acquisition of non-current assets. So here we need to know now why to prepare a cash budget. So there are different reasons are there. Okay, so which we need to consider. First, number one, the first reason is what organization must have adequate cash at all times. Why we need to have adequate cash? Maybe if you have even plenty of assets, okay, like property, plant, or machinery, but if you face the temporary shortage of cash, so this can force you into liquidation. So your business might force into liquidation. Okay, so another reason, so it's not required only, like you can prepare the budget for annual terms only. So as I told you, we can prepare the budget for shorter period as well, like even for monthly or for quarter basis. So sometimes your credit at purchasing policies also have a direct impact on the cash budget. For example, if you have a loose credit policies, so this might result in delayed cash receipts, and this is the trouble for the business again. So on the other hand, if you are taking purchase discount, like sometime your supplier offer you early settlement discount. If you will make the payments before the due date, maybe you will get some discount, maybe 2% or 3%. So this would result in accelerated cash outlays. Of course, you have to make payments quickly. Now we need to understand what which items we might include in the cash receipts and cash payments. Okay, so here we have a few examples for that. For example, cash receipts are collection, which are also called inflows. These items might include what? So it can include the cash sales or cash collection from the customer. It can also include the dividend on investment in the stock of other company. You know, sometimes you buy the stock or the bonds of other company. Maybe you will get the dividend on the stock of other company, or maybe you will get the interest on the bonds of the other company. So here the next point, same way we have next point, the interest received on investment in the bonds of other company. So you might also have interest received on loan to others. Sometime, for example, if you are a bank, maybe you are lending money to the others. So on your amount which you have lent to others, maybe you are receiving interest. Okay, this is also your cash inflows. So other items might also include, like you might have a cash received through the loan, okay, from a bank, etc. Maybe if you are taking a loan from the bank, so this is also considered as a cash receipt. So when you also issue the stock of your company to the public, so of course against the stock you will get the cash, so this is also considered as a part of the cash receipt. Then guys, sometimes during our business, maybe you might sell some segment of the business, maybe you might sell some plant machinery or equipment of the business. So whatever the money you will get through the sale of non-current asset, this is also treated as a cash receipts. And you might have also certain other cash flows. Now I'm going to talk about cash disbursement or payments, which are also called outflows. So here items included are that first item is interest payment on loan from other. Sometime, for example, if let's assume as a company we have taken a loan from the bank, and now maybe we are gonna to pay the interest on the loan, so this is called interest payment. It is treated as outflow. Then sometime we also make dividend payments to own shareholders, so this is also your cash outflows. Then you might also have a cash payment to supplier. Sometime we purchase the item from the supplier on the credit terms, so this is also we need to make payment, so this is also treated as a cash outflow. Then sometimes we also pay for the business expenses like salaries. Maybe you might have operating expenses like salaries, wages. Maybe you have to pay for the marketing expenses. You have to pay other operational expenses also. This is also treated as a cash outflow. Then you might also have a payment for the capital expenditure. Capital expenditure stand for it's also called acquisition of non-current asset. Sometimes we acquire non-current assets and we need to make payments for that, and this is also treated as a cash outflow. Sometimes you also might have a drawings. Drawings are what it's usually for the small businesses. So drawings mean to say the payments to the owner for the personal use. Okay, that is called your drawings, and it's of course it should be treated as cash outflow. Then sometimes you purchase the stock or bonds of other company. When you invest your money in the stock or bonds of other company, so you need to pay for that, so that this is also considered as a cash outflow. Then you also might have a repayments of loan. You know, if you have taken a loan from the bank, maybe you need to pay the principal amount, okay, or maybe you need to pay the interest on that, so this is also considered as a cash outflow. Then sometimes guys, repurchase of on stock, like if you are gonna to buy back your own stock, okay, so of course you have to make payments for that, so this is also considered as a cash outflows. So now we are going to talk about the format for essay style question, like how we can prepare the cash budget for the essay style question. For example, let's assume we are going to prepare for the month of April and for the month of May. So please focus with me, because this is really important to avoid any mistake regarding the format. So first of all, we will start from the beginning cash balance. Let's assume we are preparing for the month of April, and we have a beginning cash balance of $50,000. And beginning cash balance we will get from the last month, like the March closing balance will be the beginning balance of the April. Okay, so let's assume it is 50,000. Now we will add in the beginning balance. What we will add? We will add all cash receipts or collection. I told you a lot of items are there, which includes in the cash receipts. As I told you, for example, you might have a interest receipts on the investment, or dividend receipts on the stock of other company, or you might also have other cash collection, maybe collection from the customers, from the cash sale. But here I'm assuming we have, let's assume, only one items under the cash receipts or collection, which is cash collection from the sales or cash collection from the customer. So let's assume it is 224,000. Okay, so now if you will add beginning cash balance plus all cash receipts and collection, which is, let's assume, 224,000. If we will make the summation of these two values, so this is what is called cash available for disbursement. So you have a total cash available for disbursement is 274,000. Now guys, what we need to do, we need to subtract all cash payments or disbursement, so which might include the long list, but I'm assuming here we have a few items and the cash payments. Maybe, for example, we are gonna to pay the money for the raw material. Let's assume this is first type of raw material, so let's assume we are gonna to pay $51,754. Let's assume we have another raw material, which is raw material B, and we are going to make payment for that, which is $20,864. Then we are going to make certain payments for the direct labor, so maybe this amount is $48,958. Then we are going to pay for variable overhead and fixed overhead, and the amount is $4,080, and here we have a 9,000. Then what other item we have? We have, for example, we are going to also make payment for non-manufacturing cost, like administration cost, maybe marketing cost or selling cost. Let's assume it is $93,000. And then we have some payment for the capital expenditure for the acquisition of non-current asset. Let's assume it is building. For example, I'm assuming it is zero. We did not acquire any assets, or we don't have any plan to acquire any asset. So now what you will do, if you will take this cash available for disbursement and less all cash payments, this is equal to surplus of cash available over disbursement. It is not necessary you always have a surplus. You might also have a deficit. Surplus stand for if your receipts are more and payments are less, and deficits mean to say if your receipts are less but payments are more. So but here let's assume we have a surplus. Why? Because cash available for disbursement is 274,000, and if you will subtract all the payments, so you got a positive cash balance, which is surplus, and it is $46,344. Now what we will do here after that, you need to subtract here desired ending cash balance. This is really important word. It is desired ending cash balance. Like maybe as a management, you are planning to have $100,000 at the end of the April. So what you will do, you will put this value here. Now we have a surplus of $46,344, and we have a desired ending cash balance of $100,000. So it means we are facing a shortage or deficiency of cash. How much is there? $53,656. Now guys, this is overall deficit is there for the month of April. Now what we need to do, we will add one more section here, okay, because we have to make plan. If we have a deficit, so we need to make plan from where we should cover this deficit. Maybe for that we need to add here one more section, which is called financing section, because as we have deficit here 53,000, so maybe under the financing section, so we will write these things. We can write borrowing. Okay, borrowing means if you are planning to borrow that money to cover up the deficit, or you might have repayments. Repayments in a sense, if you have surplus of the cash in this period, in this month, maybe you can use this cash for the repayments of the previous loan or interest. So here, and under the repayments we have our two section. Maybe you are gonna to repay the principal amount, maybe you are gonna to repay the interest amount. Now you can see here we have a deficit here of $53,656. So what I'm going to do, I'm planning to cover this deficit through the borrowing. So this is what I will add it here. The borrowing, maybe I'm planning to take a loan from the bank, short-term loan from the bank for the amount of $53,656. So this is what is the column for total financing section. Total financing section stand for, this is the financing section. If I will make the total of these, so this will give me total of the financing section. And what at the end you will have, this is how you will get ending cash balance, which was $100,000, because we have already decided that we want desired ending cash balance of 100,000. So this value will be your ending cash balance for the month of April. Now this ending cash balance will become the beginning balance of the next month. So let's move to the next month now. Please focus with me. So next month is, we have May. So what you will do, so that ending balance of the April will become the beginning balance, cash balance for the month of May, which is $100,000. Okay, now for example, you have here, let's assume you have here, you will add again all cash receipts for the month of May. So let's assume you have a cash collection from the sale for the month of May. How much we have? $338,000. So once you will add beginning balance plus all cash receipts, so this is again equal to cash available for disbursement for the month of May, which is $438,000. Again, what you will do, you will subtract here less all cash payments or disbursement, but for the month of May, let's assume again, I'm assuming we have a same cash payments. Let's assume, for example, we are going to pay for the raw material A $59,395. We are also going to pay for the raw material B, for example, $25,840. We are also going to pay for the direct labor. Let's assume it is $60,478. We also have a payment for variable overhead. It is $5,040. So we also have a payment for the fixed overhead, which is $9,000. And we are assuming fixed costs are not gonna to change. That's why we wrote the same value in each month. Then we will write here non payments for the non-manufacturing cost. For example, you have $93,000, $93,600. Now we will also write the payment for acquisition of non-current assets. Let's assume it is again zero here. So what you will do, if you will take cash available for disbursement, which was 438,000 minus all payments, so this will give you what surplus of cash available over disbursement. For example, guys, here we have surplus of 184,647. Now what we need to do here, again, as a management, they have decided that they need to have desired ending cash balance at the end of May as well. They need to maintain how much? $100,000. So now if you will take this value, which is surplus of cash available over the disbursement, minus this value, which is desired ending cash balance, so you will get what? Surplus or deficiency of cash. So here we have a surplus because amount is positive. Now what we need to do, because here you have a positive value of the $84,647. So now what we are going to do under the financing section, so we are planning to repay the money, repay the borrowing amount which you have borrowed in the last month. we are gonna to repay that one, for example. So I will write under the repayments here, and in front of principal, for example, we repaid the money of, or we are planning to repay $53,656, and then let's assume this is 224 is the amount of interest of that loan. I'm just assuming this value. So what you need to do here, so your total of the financing section is $53,880. Now what guys you will do, so your ending cash balance will be how much? $130,767. Now the question is that how you got this value. It's quite simple, closing value, because guys here you have a surplus of the month 84,647 minus these financing payments plus the ending desired cash balance. So this will give you total of 130,767 dollars. If still you did not get the calculation, so I can tell you in this format. This calculation is for the month of May. What you have a surplus of the month $84,647. So this value from where you will get, this is the value. Okay, then what you will do, less what? Repayments of loan. This you will take from the financing section, and this is the financing section. Here you can see this value. So we will subtract repayments of loan, which is $53,880. Now it means we have an extra in May, how much? $30,767. Now we will add here plus what? We will plus ending desired balance, cash balance, which is 100,000. So this is how you will get final ending balance of $130,767. I hope it is clear. This is how we can prepare the format for the cash budget. Now we are going to move to the next section. We are going to talk about the adjustments related to the cash budget. So here we go. So it's really important. So first adjustment, and then we will do the questions as well. Okay, so you need to understand these adjustments. These are really important. So first of all, sometime in question, you also might be provided with the data of gain or loss on disposal of non-current assets, and how you can calculate the gain or loss on disposal of non-current asset. So this is the format, and which value we will take it to the cash budget. Of course, that I will tell you at the end of the adjustment. So first we are going to talk about how to calculate gain or loss on disposal of non-current asset. Okay, so usually guys, what we do to calculate the gain or loss, so we always take the sale price. It's also called cash proceed of the assets. Okay, we compare with this with the carrying value of the assets. And if you remember, the carrying value of asset is always equal to the cost of asset less accumulated depreciation. So when you compare the cash price with the sale proceed with the carrying value of assets, so the result of these two would be either the gain or loss. Here is the note: if sale price is greater than carrying value, this is considered as a gain on disposal. But on the other hand, if your sale price is less than carrying value, this is called a loss on disposal. But guys, gain or loss, we will not take it to the cash budget. No, we don't need amount of gain or loss. Actually, we need a sale price or cash proceed, which we will get through the sale of asset. But in question, straight away, maybe examiner will not tell you the cash proceed. In the question, maybe he will tell you what? He will tell you the carrying value of assets plus minus gain or loss. So this is what we will use this data to calculate the sale price or cash proceed. So here is the note. This is really important. For the cash budget, we need sale price, which might not be given straight away. So how you can calculate the sale price for the cash budget? So you will take carrying value plus gain is equal to sale price. Like here, he will give you carrying value with the amount of gain or loss. If you have a gain, so what you will do, carrying value plus gain is equal to sale price, and this sale price you will write as a inflow in the cash budget. If you are provided with the amount of loss, what you will do, we will take carrying value minus loss is equal to sale price. This is also treated as inflow. I hope it is clear, and we will practice this through the help of question also. Now we are going to talk about the second adjustments which might be tested in the exam also. Here this adjustment is related to the working capital. You know guys, when you set up any factory, maybe at the start you need to invest in the plant, in plant and machinery, maybe certain equipments, maybe you need to construct a building. So whatever amount of money you are going to invest in the non-current assets, so that is called your fixed capital. So and once you will start operating the factory, maybe you need also inventory, okay, to produce the item. So maybe you need to invest the money into the inventory, and with the passage of time, as you will start selling the product, maybe you might also have more receivables. So it means you are also investing your money in the current assets also. So whatever money you will invest in the current assets, that is called your working capital. Okay, so after that there's a one more term is there, that is called net working capital. Net working capital is always equal to current assets minus current liabilities. And in the question, so maybe you need to deal current assets separately from current liabilities. Sometime maybe he will give you the amount of net working capital, okay, which is current asset minus current liabilities. How you will deal with that? So this is what we are going to learn here. So first I'm going to talk about the rules for the current assets. What is the rule for the current assets? So guys, what you will do, so there are two, chances are there. There might be an increase in current assets over the 2 years. Okay, when you compare two periods, there might be a decrease in current assets. So whenever if there is an increase in current assets, so that you will record as a outflow in the cash budget. So if there is a decrease in the current asset, you will record as a inflow. Now the question is that why increase is treated as outflow and why decrease in current asset is treated as inflow. So let's explain this with the help of example. For example, this is the year of 2019 and this is the year of 2020 in which currently we are sitting. I'm going to talk about amount of receivable. For example, last year your amount of receivable was 1000, which is the closing balance at the end of 2019, and at the end of 2020 there is a receivable balance which is 1500. If you will compare these two value, it means there is a increase in receivable. Okay, and what is the increased amount? Increased amount is $500. So now this 500 should be treated as outflow. Why guys? Because there is an increase in receivables, and now you need to think why it has increased due to the credit sale actually. So that is why there is an outflow of resources which we have made through the credit sale. So that is why increase in current asset always treated as a outflow. But if there is a decrease in current asset, this will be treated as inflow. For example, in 2019 we have a receivable amount of 1000, and in 2020 we have a receivable amount of 800. Now you can see there is a decrease of $200. Why receivable has decreased? So due to the cash collection from the customer. So that is why it should be treated as inflow. Then we have to apply the rule for the current liabilities. So now the rule for the current liability is totally the opposite of current assets. Increase in current liabilities we will record as a inflow, and decrease in current liabilities we will record as a outflow. For example, if let's assume this is the amount of payable rather than amount of receivables, let's assume, and the payable of the last year, let's assume it was 1000, and now the payable in 2020 it is 800. It means there is a decrease in payables by 200. So why it has decreased? Maybe we have made payments. So that is why these payments should be treated as outflow. So this is what is the rule. So decrease in current liability is treated as outflow, and increase in current liability is treated as inflow. And I'm talking about here current assets and current liabilities. So guys, you might have a lot of items in the current assets. Maybe you might have for example, receivables or inventory, etc. So in current liabilities, you also might have a lot of current liabilities. But what you need to do, each line by line item, you need to compare what is the current balance, what was the previous balance. Just compare and check it has increased or decreased, and accordingly you will record as an inflow or outflow, and you have to apply this rule. This is the rule for current assets, and this is the rule for current liability. Now we have a third. Sometime directly in the question he will tell you the amount of net working capital. If you remember, net working capital is always equal to current assets minus current liabilities. So if you are provided with the amount of net working capital, so same rule you will apply which you have applied in the current asset. For example, increase in current asset was outflow, decrease in current asset is recorded as inflow. So same rule you will apply here in the net working capital also. Increase in net working capital will be recorded as outflow, decrease in net working capital will be recorded as inflow. So you have to memorize this rule. So now I'm going to move to the third adjustment, which is related to the accrued expenses. Accrued expenses has two different types of implication. If you are calculating the cash inflows or outflows on monthly basis, for example, I'm calculating for the month of April or for the month of May. Maybe the salaries of April I will pay in the month of May. So in the month of May, I should record this as an outflow. Maybe the salary of May I will pay into the month of June. So here the May salary should be recorded as a payment in the month of June. But sometime examiner, he will also ask you to calculate receipts or payments for the quarter, not for individual month. For example, you have a first quarter January to March, and you have a second quarter April to June. So if he's asking about what outflows or inflows are for specific quarters, so then here is the assumption you should make. What is the assumption? All accrued expenses will be treated as outflow, but excluding non-cash expenses. Like for example, if you have a salary of the quarter of the second quarter, let's assume $100,000, and second quarter includes the month of April, May, and June. If salary is $100,000, so even he told you it's accrued, so what you will do to solve the question, you should record as a outflow in the same quarter. But if he's asking you to calculate specific receipts or payment for specific month only, then you should check the point in which month it is going to be paid, or in which month it is going to be received. And I will explain this point more with more detail through the help of example. Now here another note is there which you should remember. What is the note? Note is that accrued expenses should not include the non-cash expenses like depreciation. Of course, depreciation is a non-cash expense, even amortization. So you should not record as a inflow or outflow. So you should have to exclude from the cash budget. For example, let's assume, I'm just giving you example. Let's assume you have a accrued expenditure including depreciation. For example, this is for the quarter. Let's assume it is $100, and this $100 also include the amount of depreciation of 50, for example, $50. So what you will do here, so you will write accrued expenses as a outflow in the cash budget. At the same time, you will add back depreciation by $50, so your net effect will be $50 as a outflow. In other words, I can do this way also. I will take $100 minus non-cash based expenses, which is $50. So remaining 50 directly I will write as a outflow. But you can do this way also. Write accrued expense including non-cash based item, then you can add back depreciation. Again, your net effect will be $50 as a outflow. Now we are gonna to apply whatever we have learned in the adjustment. So we are gonna to apply through the help of question. Let's assume we have a company. A company is in the process of projecting its cash position at the end of the second quarter. And you know, second quarter includes the month of April, May, and June. Shown below is the pertinent information from the company's records. So first he told you here, they told you cash balance at the end of first quarter. It means this is the closing balance of the first quarter, and it should be, and it will be the beginning balance of the second quarter, and you are required to do the calculation of second quarter. By the way, we will see the requirements. Then you have a cash collections from the customer for second quarter is 1.3 million. Then this is the cash receipts. Then you have accounts payable at the end of first quarter. This is the opening balance of second quarter or closing balance of the first quarter, which is 100,000. And you have here accounts payable at the end of second quarter. This is the closing balance of second quarter. And here you can see there is a decrease in payables by 25,000. And I told you if there is a decrease, it will be treated as outflow. Then all second quarter cost and expenses on accrual basis is 1.2 million. And I told you if we are doing the calculation for specific quarter, so we will assume, just to simplify the question, we will assume all the accrued expenses will be paid in the same quarter. Then we have a depreciation. Accrued expenses included above. It means the upper value, which was for the accrued expenses 1.2 million. This includes the amount of depreciation of 60,000. So it means the net effect we should take 1.14 million. Okay. Why? Because 60,000 as a we have a 60,000 of non-cash based expenses. Then they're telling you purchase of equipment for the cash. So of course it is the outflow because you purchased the asset, so you paid for that. It should be treated as outflow. Then you have a gain on sale of assets. So gain is 5,000. So we don't need gain, we need cash or sale price or cash proceed. If cash proceed is not given, I told you above, we will take carrying value plus gain is equal to cash proceed, or carrying value minus loss is equal to cash proceed. So here you have a gain of 5,000, and you have a net book value of assets sold is 35,000. So net book value is also called carrying value. So it means we have a gain and carrying value. So what we will do, we will take net book value or the carrying value of 35,000 plus gain of 5,000. So it means your cash proceed is equal to 40,000, and this will be treated as inflow because you sold the asset. Then you have a repayments. As per name, it is outflow. Repayments of notes payable. So this is 66,000. So this will be recorded as a outflow. Now from the data above, determine the company's projected cash balance at the end of second quarter. So here we have to calculate what is the ending balance at the end of the second quarter. So let's move to the solution. So here we have a solution. It's quite easy. So what we will do here, so simply we will take a beginning cash balance, which is given as 36,000. You can see in the question 36,000. We will put it here. Then we will add cash collection. It is also given 1.3 million here into the question. You can see. Then you will subtract less net changes in accounting payables, because for the accounts payable you have an opening balance of 100,000 and closing balance of 75,000. So there is a decrease by 25,000. So this should be recorded as a payment. So we recorded 25,000 as a payment here. Then here you have a less accrual basis cost. I told you this treatment. So you will subtract first full amount, and then you will add non cash expenses like depreciation, which is 60,000. Then what you will do, you will subtract less payment for equipment. I told you the payment for equipment will be treated as an outflow because you purchased the equipment for 50,000. This will be treated as an outflow. Then I told you we will take what carrying value plus gain is equal to cash proceed, which is 40,000, 35 plus 5. So you will write as an inflow. And then you have a repayments of loan, which should be treated as an outflow as 66,000. So this should be your ending cash balance of 95,000. It means if you will look at the requirement, And the options, option A was $0. So which is the correct option? A, B, C, or D? So correct option is 95,000, which should be the D. So D is the correct answer. I hope it is clear. Now we are gonna to move to the next question. Please focus with me. It's another adjustment. Sometime in the question he might also ask you to calculate payment to the supplier, and he will give you information about the purchases and about the payables. So if you are provided information about the purchases and payables, how you will calculate payment to supplier, this is really important. So this is the format. So what is the format? You will take first purchases, value purchases. You will write here. If purchases are not given, so you will use the cost of goods sold formula to calculate the value of purchases. And here is the formula for the cost of goods sold. Usually this is the cost of goods sold formula. You will take opening inventory plus purchases minus closing inventory. It's equal to cost of goods sold, because you have to calculate the amount of purchases. So what we can do, just we can reverse the equation. So how we can reverse the equation? We will take cost of goods sold plus closing inventory, because we are going reverse, minus opening inventory. You will automatically get the amount of purchases. So this is what you need here as an amount of purchases. Okay, so you will take amount of purchases plus decrease in payables, because decrease in payable is treated as a outflow, is treated as a payment. So that is why, so you will take purchases value plus decrease in payables or increase in payables. If increase in payables is provided, so you will subtract here, because increase in payable is treated as inflow. So if you will take purchases plus decrease in payable or increase in payable, this will give you net payment to the supplier. Here we also need to memorize you should remember two notes as well. So note number one is what? Decrease in inventory level. For example, if he will tell you there is a decrease in inventory level, so decrease in inventory level is treated as a opening inventory here. Okay, here opening inventory. And if he told you there is an increase in inventory level, so this will be treated as a closing inventory here, because you need opening inventory, you need closing inventory, you also need a cost of goods sold to calculate the value of purchases. And I have already written this equation here. Now we have a question to apply the concept whatever we have learned in the recent adjustment. For example, a master budget was prepared based on the following projections. So we have a value of sales, which is $2.4 million. We have second point, decrease in inventories, which is $60,000. I told you decrease in inventory always treated as opening inventory. Okay. So then you have a decrease in accounts payable. I told you decrease in accounts payable is treated as a outflow. And then you have a gross margin, which is 40%. What is gross margin? Like sale minus cost of goods sold is equal to gross margin. So it is 40%. It means if gross margin is 40%, your cost of goods sold should be 60%. So here, what is the requirement? We have to estimate cash disbursement for the inventories. So in short, we have to calculate the cash payment to suppliers. If you remember, I told you how you will calculate the cash payment to supplier. Let me just take you to the format. I told you we will take purchases plus a decrease in payables or less increase in payables. This is what is called net payment for the inventory or net payment to the supplier. So from this data, now what we are going to do, we are going to apply the concept. So first we need to calculate the amount of purchases, because purchases amount is not given. So but he told you this thing. He told you a sale value, you are provided with the sale value, and you are provided with the GP percentage. So sale value is how much? 2.4 million. It is given in the question. Just we will write it here. And less from the sale, we will subtract cost of goods sold, which is 60%. Why? Because GP percentage is 40%. If you will take 40% of the sale was how much? 2.4 million times 40%, you will get amount of GP. And difference between sales and the gross profit. So difference will be what? Difference will be cost of goods sold, which is the 60%. So here we got cost of goods sold as a 1.44 million. Now what we need to do, we can reverse the cost of goods sold equation to calculate the value of purchases. So what we can do here, we can write the cost of goods sold plus closing inventory minus opening inventory. So you will get the amount of purchases. Okay. So cost of goods sold, we just have calculated, it is 1.44 million. So plus closing inventory is 0, less opening inventory is 60,000. As I told you, decrease in inventory will be treated as opening inventory, which is 60,000. So you will get the amount of purchases, which is 1.38 million. Now we can calculate the payment to supplier. What we will do, we will write the amount of purchases and plus decrease in payable or minus increase in payable. So amount of purchases just we calculated here, which is 1.38 million. We will write it here plus decrease in payable, because decrease in payable is given in the question. If you will look at here, it told you decrease in accounts payable is 100,000. So you will add it here. So this is how you will get payment to the supplier, which is 1.48 million. So it means option B is correct. Now we are gonna to discuss how to reach cash balance by using income statement data. Like sometime you will be provided with the income statement data in the question, and how you will convert the income statement data to the cash flows. Okay, it's really not easy, I would say. So it's simply like there is a reversal, because sometimes we wrote a lot of items which are non-cash. Okay, so we need to reverse those items. And plus in the income statement, we don't write capital expenditure like acquisition of non-current assets. We don't write, we need to write those things as well. So, but here we are going to talk about the format. Okay, how to convert the income statement data into cash flow. So this is really important. You should focus here. So what guys you will do, this is the condensed format is there. So first of all, you will take net income from the income statement. You will take that value, and plus you will add here non-cash expenses like depreciation or amortization. You will add here less capital expenditure for the acquisition of non-current asset, because we don't write into the income statement, it's recorded in the balance sheet, but it is outflow, so you need to subtract here. Then plus decrease in working capital, because working capital stands for current assets minus current liabilities. Okay, if the working capital has decreased, you need to write as a inflow, because it is not written in the income statement. Less what? Increase in the working capital. If working capital has increased, okay, so you will write as an outflow, because it is not written in the income statement. Then you will add your opening balance of the cash if you are provided with the opening balance. So this is how you will reach to the closing balance of the cash. And how to apply this format, let's have a look with the help of question. Okay, so we are going to move to the question. A company has just completed its prospective financial statements for the coming year. Relevant information is summarized below. So here you are provided with the data of projected net income. It is $100,000. You have anticipated capital expenditure 50,000. As I told you, capital expenditure you will write as an outflow when we prepare cash budget. Increase in working capital is 25,000. And I told you increase in working capital will also be written as outflow. And then you have a depreciation expenses, 15,000, which is included in the net income. So it's a non-cash based item. So we need to add it back. So from the information provided above, the increase in the cash account for the coming year will be, so we have a 4 options, either it is 25 or 40 or 90 or 160,000. So how you will do it now? Just we need to reverse the income statement data. So what we will do here, you can look at here. So simply we will take accrual basis of net income, like it's a profit from income statement, which is 100,000, and it is given in the question. Less capital out expenditure, which is 50,000, because we need to make payments to acquire the asset, and less increase in working capital, which is $25,000, because increase in working capital we will record as an outflow. Add depreciation expense, because it's a non-cash based expense, which is 15,000. It is also given in the question. So this is how you will get increase in cash balance of 40,000. It means option B is correct option. Now let's have a look to another question. So this question, you might also be given question like that in real exam. Just we are going to read the question. A company has developed the following sales projection for the calendar year. We have a month of May, $100,000. It's a sales. June, 120,000. July, 140,000. August 160,000, September 150,000, October 130,000. So normal cash collection experience has been that 50% of the sales are collected during the month of sale. Like for example, if you're selling in June, so 50% of sale you will get in June, okay? And 45% in the month of following sales. Like if you are making any sales in June, so 50% you will receive in the month of June and 45% you will receive in the month of July, okay, because it's following the sale. The remaining 5% is never collected. It means it's a bad debt, and bad debts we don't need to consider when you calculate the cash receipts. The company's budgeted cash collection for the third calendar quarter. So it means they're asking about not for the specific month, they're asking for the specific quarter. Like for the third quarter, you have to calculate the cash collection for the third quarter. It means third quarter includes the month of July, August, and September. Whatever receipts will fall in the month of July, August, or September, so we will take it, and we will at the end we will make the summation. So let's have a look. So how you will do the calculation? If you will look at the May data, so May, he told you for the May we have a sale of 100,000, and he told you out of this 100,000, 50% will be received in May, okay, 45% will be received in next month, which is June, and it means 5% is uncollectible, and it means nothing is falling in the month of July, nothing is falling in the month of August, and nothing is falling in the month of September. It means we don't need to consider the May. So let's start with the June now. So June, for the June we have a sale of how much? 120,000. Let's look at the solution. And 50% will be received in the same month. It means 50% will be received in June. We don't need, because we need receipts from July, August, and September. But 45% will be received in July. Yes, July falls under third quarter. So we will take what? 120,000 times 45%. This will be 54,000. Then from the July sale, you have a July sale here, 140,000. So here you have 140. 50% will be received in July. You don't need to consider, so you need to consider, sorry. And 45% will receive in August, and 5% is bad debts. It means 50 plus 45, we will take 95% of July sale, which will fall in the third calendar quarter. Then from the, which is 133,000. Then from the August sale, of course 50% will be received in August, and 45% will be received in September. It means August and September falls under third calendar quarter. So it means we will take 95% of August sale. So this will be 152,000. This will be recorded as a cash receipts. And then we have next one, September. September sale is 150,000 given in the question. 50% will be received in September. Yes, September falls under the third calendar quarter. So and 45% will be received in October. You don't need to consider. And okay, what we need to do here, guys, simply what we will do, we will take September sale times 50%, so which will be 75,000. If simply you will add all these amounts, let's make a total. If you will just add, so this will be the amount which is 114,000. This is what is the cash collection for the third calendar quarter. So option C is correct. I hope guys it is clear. If you have any question, you can ask. Sometimes you also might be provided with the data of purchases. Like here, you are given the data of sales, and that's why he asked about the cash receipt. Sometimes he will give you the data about the purchases, and same way he will tell you maybe 50% of purchases we will uh, make payments in the same month, maybe 45% or 40% in the next month. So, but if you are provided with the data of purchases, so he will ask you the question related to cash payment. I hope it is clear whatever we studied. Okay, guys, see you in the next video. See you. Bye bye.